Hello everyone, welcome to Just Invest Today, and in today's video we have a great video for you guys. Today we are talking about the new 13F filings for Q1 2022. They're coming out today and we have some huge news, man. Greg Alexander sold off all his Alibaba shares. Say it ain't so. Can you believe this, guys? Like, he actually did this. This is one of the guys that actually put a lot of money on the line for Alibaba and even bought down during the drawdowns. That didn't matter. He sold all his Alibaba. And honestly, I'm going to contribute this to Charlie Munger himself. When Charlie Munger sold, I feel like a lot of people kind of followed him because we know why Charlie Munger sold is because all the tax loss harvesting that he wanted to do. So when it comes to that, I think he got a lot of followers, and I think one of those people was Greg Alexander. Warren Buffett himself said that he would invest with Greg Alexander if he were to retire. He was under Bill Ruane at that time. For him to find out about kind of Greg Alexander, that's huge because he wasn't well known. He doesn't do a lot of interviews. So that says a lot because Warren Buffett said he would put his money if he retired with Lilu, with Seth Klarman, and with Greg Alexander. So that's big. You know he has that value investing mindset and he does deep research. So he sold off all his Baba. And this is not like some small sale. This is huge. He had 17% of his portfolio in Baba and he sold it all off. So my reason, and the thing is too, and he still has JD.com, which is very interesting. He probably sees JD.com less risky than Baba. On top of that, he's probably doing himself the favor of tax loss harvesting because he's seeing this huge opportunity at hand right now. Because look, he put 172% in this new company Yandex. He has 71% in Remini, Stree, and Equitable Holdings, 10%. So he's probably seeing a lot of opportunities. So he's probably taking that tax loss harvest and putting it into these three companies. So with this huge sell-off, I have to do rethinking, and I'm rethinking as well. I'm always rewinding, reevaluating the companies that I own. If you really look at Baba, I'm going to be 100% honest with you guys, man. 100% honest. Because you already know, I have a huge stake in Baba. It's like 20%, 25% of my portfolio. So I'm well into Baba. I still believe in the company. But that does not mean we shouldn't reevaluate the company, look at what Baba's doing, look at the expectations for the company. So right now, Alibaba is selling for $238 billion. So if we really look at the sum of all parts of Alibaba, everyone knows, we established this Alibaba is very undervalued. It's crazy undervalued. It's selling cheaper than pretty much its like IPO price, or kind of selling cheaper than 2014. Guys, we know how much Alibaba has grown since 2014. So it's not some crazy theory to come to the conclusion that yes, Alibaba is worth way more than 2014, right? So that's not the question, because we know cloud computing is growing 20-25%, and that's going to grow into the future. They still have Taobao and Tmall, which is still growing. We still have their international companies, Lazada, we have Trendable, we still have Ant Financial, we still have all the investments in their securities that they own. We have a lot of stuff. They have a crazy good logistics service. So we understand that the sum of parts of Alibaba as a company is worth more than $238 billion, and the company is growing. But if you're looking at the earnings, just the legit raw metrics of earnings, we have to hold Alibaba accountable. We have to, because we have to keep realizing that this company is losing on the margin side. Like the gross margins, 63%, 57%, 45%, 45%, 41%, 37%. So this is a declining margin. Even though the revenue is growing really fast, really good, it's declining in margin. So is this short term or is this a trend? Because people keep going back to competition and the government. So how is this going to play out in the future? We have to kind of keep our eye on that, because Alibaba has said they're going to kind of improve their margins and operating margins and gross margins as they step back from spending a lot of money on kind of unprofitable businesses or unnecessary like spend. So let's see what happens with that. So we have to honestly look at the gross margins, because they used to be 30, 28%, 16%, but now they're at 10%. Like, that is getting iffy. What if it goes down to 9, then 6, then 5? We have to look at that and see what Alibaba's kind of doing about the operating margins. Even though I feel like the operating margins going down is not as bad as people make it out to seem, because it's been a crazy market. It's been crazy. The tech crackdown, then we got them building out more on the ground level. Like, they're building more supermarkets. They're spending more on like delivery services. They're actually getting into like smaller regions. So that's all having a negative effect on their margins. Plus, they're giving out like coupons and stuff like that. So we can kind of see why the operating margins are going down. But we have to see this go back up, because this is all affecting the earnings of the business. Like, we just can't deny that this is affecting the earnings of the damn business, as we see net income has been going down kind of this quarter, or not even going up that much. Even the ratios, like return on equity, has been going down like crazy. Like, this is not good news for Alibaba, but we have faith in the company. We have faith in the management that they're going to kind of go back on track. They're going to reduce the spending, and they're going to kind of go back onto like what they've been doing. So we'll see what happens. We can give this company 2 years to perform. We know on average, like, this is undisputable, this company is worth at least $200. This companies are worth at least $200. Like, that is the low end of the company's range, $200. So we have a good margin of safety on this company, in my opinion. $200 in 2 years, I think that it can get to $200 in 2 years. What do you think? If it can't get to $200 in 2 years, man, that's gonna be bad. But I think going back to Greg Alexander, I think he's just seeing better opportunities in the market right now. You think Google is a better buy right now, and that's what I kind of think Greg Alexander is probably seeing. Selling all Alibaba, getting that tax loss harvesting, and buying new companies. In my opinion, I think right now, honestly, if I wasn't down so much on Baba, I would probably sell some of it to buy Google. There's so many new opportunities in the market that are just glaring at you, that I feel like have maybe a better opportunity, because Google already has those operating margins, those gross margins growing 20-30% a year, right? And now we have to rely on Baba to kind of go back to what they were doing in the past, and that has an execution risk. We can't deny that has risk coming down to it. All we need is Google just to keep doing what it's doing. But Baba, it has to kind of outperform now. It has to perform like Baba has to kind of go back to what it's doing. And can it get that wave again? Can I get that kind of spark again? So we're going to see in the next earnings report. But even these earnings report is not going to tell the whole story, because it just came off as zero COVID policy. And you know how that had a huge effect on everything. So we have to give Baba at least 2 to 3 years to see how it's going to pan out and what they're doing with the cash. We see they're doing a crazy amount of buybacks, so it's really positive. They're looking into ways to return the capital to us shareholders, so we can see that as being positive. But give the company 2 to 3 years, maybe even longer, to see if Baba can get its footing back. We already know that Baba is the most dominant company right now in China. Is no ifs, ands, or buts. Baba or Tencent. So we understand that Baba has a lot of runway. They have a lot of levers to pull to kind of get back to where they were. Their gross margins, their operating margins, continue their revenue. So I'm not down on Baba, but man, if Baba was at 200, I might sell off to probably buy some Google, because I think Google is very undervalued at these levels. Guys, what do you think about Greg Alexander selling 17% of his Baba holdings? Why do you think he did that? Was it tax loss harvesting? Was there better opportunities in the market? Was it some other things? Maybe there's too much risk with Baba in China. He's taking some kind of risk off, because we don't know what's going to happen with the Chinese government or what's going on with China. So guys, what do you think, man? Like this video, subscribe to my channel, and I'll get back to you in the next video. Peace.